Today, we are facing down the risk of $100 oil. Don't dismiss this, because $100 oil is a serious risk for the global economy. And soon, it could become a reality that we all need to face. In this video, I'm going to talk about the danger of oil shooting past $100 and how it can affect your investments, your trades, stocks, Forex, and the financial markets as a whole. I'll also talk about how to use oil to trade Forex and stocks. The price of oil is supposed to be determined by supply and demand, but as you can imagine, it is not that simple. The price of oil, or the price of anything for that matter, can be manipulated, but there's no manipulation as regular and as overt as the oil market. The world's largest oil-producing nations are part of a gang, or cartel, known as OPEC, the Organization of Petroleum Exporting Countries. Now, there are 13 official members who meet every 6 months to agree on how much oil to produce, and that directly affects the supply and, in turn, the price of oil. The most powerful members are Saudi Arabia and Russia. Now, Russia is not part of OPEC, but they are a part of OPEC+. The U.S. is actually the world's #1 oil producer, but the U.S. is not an OPEC member. Now, get a little closer. I'm going to share with you a little secret. OPEC does not set their production levels based on demand. Surprise, surprise, they set supply based on their economic and political motivations. For example, it is well known, according to the IMF, that Saudi Arabia needs oil prices to be at $81 a barrel to balance their budget. Anything less than that, they could be in a deficit, which they don't want. Russia wants oil prices to be higher in order to grab more funds to fund their war with Ukraine. All of this matters because it gives us a sense of how long oil prices could remain high. Two of the world's biggest oil producers are very motivated to keep oil above $80 a barrel, and ideally higher. So don't expect prices to fall anytime soon. In fact, they could get higher. In September, OPEC nations extended their supply cuts to the end of the year, even though growth is slowing because of their own political motivations, which is why $100 oil is the path of least resistance. What happens when oil hits $100? Nothing really. It's really just a number. But let's be realistic. Brent already went above $90, so $100 is really not that far away. But it is psychologically important, and it's very, very hard for many countries to grow when oil prices are high, because higher oil prices act as a tax on any country importing oil. This includes major oil importers like France, Germany, Japan, South Korea, and India. They will feel the most pain if prices hit $100, $120 a barrel. Now, if you're trading oil, you should know that oil is priced in dollars, and U.S. energy independence and its net exporter status leaves the dollar well positioned for an increase in oil prices. But oil is still a net drag on growth, as you can see in this chart. The U.S. experiences a weak phase of growth in the quarters to follow after oil prices spike above $100, because when that happens, we're basically looking at $5 a gallon gas in the U.S. High oil prices is bad for U.S. growth, and I've circled the periods where growth is weak when oil prices are high, because it acts as a tax for consumers and businesses. As you can see in this chart of oil in the S&P, whenever oil prices broke above $100, a sharp sell-off in the S&P 500 index followed. So for traders, that means weaker growth in the US, Eurozone, Japan, and South Korea, and a potential opportunity to sell stocks if oil continues to rise. Take a look at this chart of oil in the Nikkei, with the Nikkei being the gold line and crude futures being the blue line. When oil prices broke above $100 a barrel in March 2022, which is marked by the black line, the Nikkei crashed, and the whole period that oil remained above 100, the Nikkei was unable to rally. You can also see the same dynamic in the German DAX, which is the green line in this chart, which was hit a lot harder than the Nikkei when oil broke above $100 a barrel. So these are all potential trading opportunities for those of you that are trading Nikkei, DAX, S&P indices. Now, it should be no surprise that the surge in oil price is also bearish for Euro. My Forex traders, Euro is the blue line on this chart, which also fell hard from February to July of 2022, the period that oil remained mostly above $100. So even though rising oil prices drives up inflation, and it is for the first time this year, oil will be boosting rather than diluting inflation because it is up year over year. At the end of the day, investors are much more worried about the impact on growth than inflation. So $100 of oil is bad for Europe, a major oil importer, and the euro, one of my favorite currencies to trade. It is also bad for the DAX, an instrument that futures and CFD traders love to trade with Boris in his live trading room. Another way to look at this is that if you think oil will break $100 and stay above it for some time, then selling euros may be a smart trade. Meanwhile, $100 oil is great for the currencies of oil-producing nations like Canada. Canada has the world's third largest oil reserves behind Saudi Arabia and Venezuela. So the Canadian dollar tends to benefit from rising oil prices. Now, Canada has its own problems with growth and other things. It may not be enough to offset the decline, but it could drive the loonie higher and provide opportunities in the crosses, and it could ease the losses in the Canadian dollar. So looking at trading the Canadian dollar against the crosses could be a great opportunity if oil prices are rising and the currencies of our other countries are weakening as well. Also, oil prices could keep a central bank like Canada in tightening mode for longer because more profits in the energy sector, combined with the inflationary impact of rising oil prices, makes it difficult for high inflation to ease. In this chart of oil and the Canadian dollar, you can see the Canadian dollar shooting higher against the US dollar when oil prices broke above $100. This chart of CAD yen, you can see the Canadian dollar Japanese yen currency pair also has a strong positive relationship with oil prices, which means when oil prices rise, CAD yen rises. But I'd be careful buying CAD yen now, even if oil prices break 100, because the risk off trade could be a bigger driver of Canadian dollar movements than oil. Now, the best way to combine the story of $100 oil with technicals is to wait for the charts to be aligned with fundamentals. For example, if I think that oil is going to 100, but I see that dollar CAD has been in my zip buy zone, like it is here, I won't be looking to trade dollar CAD because $100 oil should actually be driving dollar CAD lower and not higher, and I want to see it in my zip sell zone. In this case, the technicals are not aligned with fundamentals, so pass. The better trade would be to sell Eurodollars, which has been in the zip sell zone, like you see in this chart here. Because in this case, the fundamentals and technicals are in sync. So what I want to do is I want to see the fundamentals and technicals support my trade, where I know that $100 oil is bad for euro. So if you think oil is headed to $100 and you know that's bad for the US, you know that's bad for the Eurozone, but it's worse for European growth because they are net oil importers, then selling euros could be the smarter trade if the technicals and fundamentals are in sync, and it confirms that you should be selling. On the flip side, if OPEC suddenly decides to increase production, which would drive oil prices sharply lower, one of the best trades may be to buy euros and sell the Canadian dollars because that's a really nice cross opportunity. Just check the charts to make sure it's in sync with your trade. Now, $100 oil is a headline-grabbing number that poses a realistic risk for consumer and businesses, but the real threat is $120. That's when it becomes a serious headwind. So hopefully you've gotten a sense of where the opportunities are, and if oil breaks $100, what your trades could be. If you enjoyed this video, please take 2 minutes to like and subscribe to my channel. And if you want to learn more about how to use my zip indicator to filter out the trades, check out the link in the description below. I'll see you next time.